If you spent any time on YouTube lately, you've probably seen the claim, the IRS will tax you for 10 years after you leave the US, or some sort of version like that. Some new law, massive penalties, no escape. Well, some of that is true, but most of it's exaggerated. And it's pure clickbait, designed to scare you into clicking and not actually inform you. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and have been running an international tax firm ever since, working with Americans in over 93 countries. I've watched these rules change 3 separate times. Today, we're separating what's true, what's outdated, and what's pure clickbait, and what you should be actually planning for. Let's start with the claim that's everywhere right now. The idea that after you renounce US citizenship, the IRS taxes you for 10 years. Here's the real version. There used to be a rule called Section 877. It taxed certain people who renounce for 10 years after the fact if the IRS believed they renounced primarily to avoid US tax. That rule was largely replaced in 2008 by a different system called Section 877A. The new system is a one-time event, not a 10-year sentence. So when someone tells you the IRS will tax you for 10 years after you leave, they're describing a rule that was mostly retired before the iPhone 4 came out. The truth is more complicated, and that's the actual current rule, the exit tax, which is what you should be paying attention to. That's the headline. Now let's talk about what actually is on the books today, because that part matters the most, and almost nobody on YouTube explains it correctly. So there's 3 things every American thinking about leaving needs to understand. First, the US taxes its citizens on worldwide income for life. This is the foundation. The United States is one of only 2 countries on this earth that taxes based on citizenship rather than where you live. The other one is Eritrea, an African country. Now, as long as you hold US citizenship, you have to file a US tax return every year, no matter where in the world you live. You move to Lisbon, you move to Dubai, you move to Mars. If you're a US citizen, the IRS expects a return. This isn't new. It's been the rule for over a century. But a lot of people moving abroad don't realize it applies to them until their first tax season overseas. Second, the exit tax is real, and it's significant for high earners. If you actually renounce US citizenship, the IRS may treat you as having sold every asset you own the day before you renounce and tax you on those gains. This is called the exit tax. It applies to what the IRS calls covered expatriates, which generally means people with a net worth over $2 million, or people who had an average tax liability over a certain threshold for the previous 5 years, or people who just haven't been compliant filing their taxes for the last 5 years. So for someone with substantially appreciated assets, this can be a very large tax bill. And for someone with modest income, it could be nothing. So the point is, it's a one-time event at the moment of renunciation, not a recurring 10-year tax. Third, new forms get triggered the day you move abroad, even if you keep your citizenship. This is the part most people get blindsided by. The moment you have a foreign bank account or foreign business or foreign assets, new IRS forms come into play. The FBAR if you want foreign bank accounts that cross over $10,000 at any point in time, Form 8938 for foreign financial assets above a certain threshold, Form 5471 if you own a foreign corporation, or Form 2555 to actually claim the foreign earned income exclusion. Missing these forms could trigger penalties starting at $10,000 per form per year. Now, I've reviewed hundreds of returns where domestic CPAs that file the same return after the client moved abroad, same Schedule C, same deductions, 0 new forms. The client thought they were fine, they weren't. They just had not been caught yet. So those are 3 things that are actually true. Citizenship-based tax, the exit tax, and the new forms get triggered abroad. Now let's clear out the noise that's making it hard for people to think straight about this. 3 claims that you'll see constantly that just aren't true. Clickbait 1, there's a new law that will tax you forever even after you renounce. Now, there have been proposals along these lines, but none of them have become law in the form that the headline suggests. So when someone tells you that, oh, they passed a new law. Well, ask them which bill, when it was passed, and what section of the tax code. Because the usual answer is, well, it was proposed or it was discussed. Well, proposals and discussions are not laws. Clickbait 2. If you move abroad, you'll be double taxed on everything. Now, this ignores 3 of the most important tools in the international tax code. The foreign earned income exclusion, which lets qualifying Americans exclude up to $130,000 of earned income from US tax every year. The foreign tax credit, which prevents most actual double taxation by crediting taxes paid in another country on the US return. And the tax treaties between the US and over 60 other countries. Now, are people that move abroad without using these tools sometimes double taxed? Yes. Is double taxation an automatic consequence of moving abroad? No. Clickbait 3. Just renounce and you're free. Now, renouncing US citizenship is a real, legal, and sometimes the right call. But it's also expensive, irreversible, and it comes with the exit tax you talked about. It's a permanent decision with permanent consequences. So anyone who's telling you that it's some sort of quick fix is just selling you something. Now, with the clickbait out of the way, here's what someone who actually wants to do this right needs planning for. Here are 3 things in this order. 1, tax planning before the move. The most expensive mistake we see is people who move first and figure out the tax piece second. The timing of your move, the state of residence, and your business structure, and the country that you move to all interact in ways that determine your tax bill. So some of these are reversible after the fact, but most aren't. 2, understanding which tools actually apply to you. The FEIE works for some people and not for others. The foreign tax credit is better in some countries, but not others. Tax treaties differ wildly between countries. And renunciation makes sense for some clients, but could be completely wrong for others. There's no universal answer. There is only the right answer for your specific situation, which depends on your income type, your country, your assets, and your goals. 3, working with somebody who actually does this. And that's not because we're advertising, even though we are, but really because most CPAs don't handle the international piece. And the ones who do are the difference between leaving 5 figures on the table and not. Now, the clients we've seen do the best are the ones who got the strategy right before the move. The ones who struggle the most are the ones who try to fix it after the fact. So here's the honest summary. The IRS does follow its citizens around the world for life. The exit tax is real. The new forms abroad are real, but most of the viral fear content about this is exaggerating, outdated, and designed to scare you into a quick decision. The smart move is to understand the actual rules, plan around them deliberately, and not yet YouTube panic drive you into either inaction or the wrong decision. If you want to go deeper, the next video on the screen breaks down exactly how the foreign earned income exclusion works, which is the single biggest tax break available to Americans living abroad and the most important tool in the entire conversation. Watch that next. And if you're thinking through any of this for your own situation, the link below will get you on a call with our team. The earlier in the process you talk to someone who actually does this work, the more options you'll have.